What is up, guys? Mike Wang here. Today I'm going to be introducing a guy who made 100x returns on a single stock and his 7 secrets on how he managed to do so. The guy we're going to be talking about is an engineer by the name of Ram. He shared his story on Twitter and I think his story is worth going over. He bought his Lululemon stocks back in February of 2009 with an average cost at $4.173, and with Lululemon's price currently exceeding $424, he is currently up 10,000%. He wrote about his lessons learned over 12 years, and there are 12 tips overall, but I chose the 7 most important tips to share with you guys. Now, before we begin, I'll provide a brief explanation on what Lululemon is for those of you who don't know the company. This is a sportswear brand that was established in Vancouver in 1998. Essentially, you could say that this company created the leggings that we see today. The founder went to a yoga class with his wife and found out that people were wearing clothes made out of cotton, so he felt the need for a more functional sportswear. The company is also famous for its pricing on its products. Their leggings are at least 3 to 4 times more expensive than that of other companies like Nike or Adidas, so Lululemon is also referred to as the Chanel of yoga wear. So let's dive right into the 7 secrets to Ram's success. The first secret is to be open-minded. It's about acknowledging the fact that good ideas can come from anywhere, anyone, or any sector. In the case of Ram, he read Peter Lynch's One Up on Wall Street, which is a great book, by the way. I highly recommend it. And he decided to invest in sports brands. In the book, it says that you should be investing in sectors that you're familiar with and that you know well. And in Ram's case, it was sports brands. So Ram started going through articles after articles and conducted a series of fundamental analyses to decide which sportswear company to invest in, and he chose Lululemon. It was at its beginning stage at the time, but already a profitable company, and he liked the name and how catchy it was. But obviously that shouldn't be a reason for you to invest in a company. He also found out that the well-being trend was just getting started and that Lululemon could play a big role in it, and he also liked the fact that the company was led by its founders. The second secret is that bad news can be good opportunities. Investors can talk about a company's intrinsic value, but when the market crashes, fear takes over and everyone seems to overlook the long-term perspective and factors that may even be considered common sense. For instance, Lululemon got listed in 2007, and right afterwards, the financial crisis of 2008 broke out and the stock crashed from $27 to $2. Ram's average entry was $4 per share, so he was at a 50% loss for weeks. But Ram understood that it was a problem of the market rather than a problem of the company itself. So he knew that there was no problem with the intrinsic value of the company and the long-term outlook. Moving on to the third secret, Ram talks about how to choose a prominent company to invest in. But before we go over his criteria, don't forget to smash that like button for the YouTube algorithm and support me on YouTube. Also, make sure to obliterate the subscribe button if you haven't yet. So a few things he looks for when choosing a prominent company are these factors. First, it needs to be small in size, so it needs a small market cap. It also needs to be growing with momentum, profitable, led by its founders, and it needs customer loyalty. In the case of Lululemon, it was already showing a steady growth rate and their products had great margin. It had no debt and dilution, but great earnings and cash flow. Not to mention the fact that this was all possible because the company had a proven business model. So if we look at the company's financial statement from 2012 to present year, we can see that the company's revenue quadrupled in 2021 compared to 2012. Its net earnings also more than tripled, and in terms of the number of shares, it actually decreased because Lululemon has been buying back its shares, which is good for investors. What's most impressive is the company's free cash flow, which increased by a whopping 7x. Now, the fourth secret is that stocks bounce really hard and fast from the bottom. In the case of Lululemon, it bottomed out in March of 2009, and until April of 2010, for 13 months, this company did 8x in growth. Buying when there's blood on the streets is a real thing, and that's exactly what happened with Lululemon as well. Especially since most companies that are fundamentally pretty solid are relatively overvalued. When the market gets oversold, that's when you know it's a real opportunity to buy. Of course, you would need the testicular fortitude to execute that investment decision, knowing that stocks can recover much faster than you normally think. So this is the chart of Lululemon's stock's price during 2009 and 2010, and as you can see, this is one hell of a recovery. It rallied over 700%, while the S&P 500 did 50% during the same period. The next secret is that stock returns are not evenly distributed over time. What this means is that there are times when the price skyrockets and there are times when it just shows sideways action. From April 2011 to November 2017, the stock's price ranged between $40 and $60. But during this time, the company's revenue and earnings doubled. So thinking about the reasons why Lululemon's price remained the same, despite their fundamentals improving, he came to several conclusions. First, this was a period in which Lululemon was digesting the steep uptrend it underwent, and since it was relatively overvalued for what it was, the sideways action was essentially time for Lululemon to cool down a little bit. So the price moved first and remained up there for a while until the fundamentals caught up. Overall, the revenue and earnings did increase, but there were earning shock issues during a few quarters, which is what prevented Lululemon from continuously rallying upwards. Marketing issues were a problem as well, and investors were paying less attention to this company than they used to. Fact of the matter is, this isn't limited to Lululemon. It's commonly spotted among other stocks like Microsoft, Amazon, Tesla, and Nvidia, which have shown huge growth trajectory over a long period of time. These stocks have had periods where the price ranged between certain support and resistance levels and where investor interests were low. And that's when you want to get in. So if we look at Microsoft, it barely moved between 2005 and 2013. And in the case of Tesla as well, it had a very long phase of accumulation or sideways action before breaking out upwards and forming a parabolic trend. Now, the sixth secret on making 100x returns has to do with how you deal with bad news about the company. If you hold the stock for the long term, management and marketing issues and scandals are inevitable. Today, Apple is a tech giant that we can't even possibly imagine could fail. But when the first iPhone came out, Apple also had to undergo scrutiny. Intuitive Surgical, ticker ISRG, which is a surgical robotics company, Chipotle's E. coli outbreak, and Peloton's recall issues, they're all on the same line, and you go through them as an investor. Lululemon had the yoga pants scandal in 2013 as well, where the founder said women's bodies were to blame for the yoga pants issue. So bad news happens, but what's important is how the company deals with that problem. As an investor, it's your responsibility to check the facts and do your due diligence and understand the situation. Based on your understanding, you modify your investment thesis if you have to. The goal is to balance yourself between conviction and confirmation bias. And lastly, the core secret to 100x returns is that long-term mindset rewards the quality companies and patient investors. As humans, it's easy for us to be perturbed by the daily volatility and noise. And holding the same stock for a very long period of time can be tiresome. You get bored. You also start thinking, what if I made the wrong investment decision? And this inner voice gets louder and louder when the stock ranges sideways for a long time. But it's important to have patience and conviction. Also, Ram shares a list of a few other companies that he thinks could potentially do 100x like Lululemon. The first company is Intuitive Surgical, ticker ISRG. He bought this back in March of 2009 and it's up about 3,500%. This is a company that develops surgical robots and has a competitive edge in that field. The second company is Mercado Libre, an e-commerce company based in Argentina. He bought this company's stock in May of 2014 and is up about 2,100%. This is basically the Amazon of South America, with a huge South American population and the beginning of e-commerce in that region. He sees big growth opportunities. This is a company that is also expanding into other areas like fintech, but since it's a company based in Argentina, the political and economic instability could play a factor. Now, of course, in this video, I did cover Ram's story, which is a story of success that rewards long-term holders, yada, 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 but that isn't necessarily always the case. It's easy to look at the data now and say, well, if I just bought and held Apple stocks when it was first mentioned in Forrest Gump, I'd be a millionaire. But really, it's much easier said than done. It's important to understand survivor bias, and there is a story from World War II that best explains this. So during World War II, the Allied forces were looking for a way to reinforce their aircraft armor to withstand anti-aircraft guns and ensure a greater survival rate. So they took a look at the aircrafts that returned from the battle and located all the places where there were bullet holes. They decided that the parts where there were the most holes, like the wings and tail, were the parts that needed reinforcement. But someone else from the team pointed out that only the planes that returned were included in the research data. If we see a large cluster of bullets on the wings and planes that returned, it means that the bullets in the wings did not cause the planes to crash. Instead, attention should be paid to the areas where there aren't any bullet holes, like the engines and cockpits, because planes that have holes in engines and cockpits did not make it back. This is called survivor bias, and we see this in the stock market as well. Look at the list of companies by market cap 20 years ago, and look at the list today. Some companies didn't even survive at all, and others haven't shown any meaningful growth that beats the market. So when you invest in stocks for the long term, it's really important that you choose high conviction stocks based on your fundamental analysis and take a very methodical approach in understanding the stock you invest in. And if you need help with analyzing stocks on a fundamental and technical level and want to learn how I do it myself, make sure to check out my newsletter on my website. Link is in the description below to this video. So that is it for today, guys. These are the 7 secrets of becoming a successful long-term investor that I think could be of huge help to a beginner and intermediate level investor. If you like this video, make sure to smash the like button and support me on YouTube. Subscribe for more quality content, and I'll see you guys in the next video.